The monthly payment trap, $487. That is the number Vance writes on a 4-square sheet of paper. He circles it twice. He doesn't circle the $34,650 sticker price. He doesn't circle the 7.9% interest rate. He circles the $487 because he knows your biology. You're sitting in a swivel chair that squeaks when you breathe. The showroom smells like industrial carpet cleaner and cheap espresso. Vance asks if that number works for your lifestyle. This is the moment the trap's shut. By nodding, you have handed over the keys to your next 72 months. You are negotiating in units of breath rather than units of capital. Vance is a technician of desire. He knows that if he can make the monthly installment fit into your direct deposit, you will stop looking at the horizon. You see a car. Vance sees an amortization schedule designed to extract the maximum amount of your life energy. You aren't buying a Honda Civic. You are buying a $487 recurring leak in your future sovereignty. While you are imagining the sunroof open on a Saturday, Vance is calculating his commission on the spread. He hides the term length. He hides the total interest. He makes the number work by stretching the debt until it becomes a silent, heavy ghost that follows you into your 40s. You check the paper. You look at Vance. You look back at the paper. The math seems fine. It isn't fine. You're focused on the ripples. The shark is already under the boat. This is how you spend your 30s as a payload for the dealership's quarterly targets. You feel like a customer. You are actually the product. You could have walked in with a single number in your pocket, the out-of-the-door price. You could have refused to speak in monthly terms until the price of the metal was locked. You could have anchored your reality in the dealer invoice price, knowing the 2% holdback already secures their profit. The Rate Markup Silence, 11:43 p.m. You're sitting at your kitchen table with a laptop screen lighting your face. You're looking at a PDF of the contract you signed 4 hours ago. 10.4%. That is your APR. You have a 712 credit score. You thought 10.4% was just the market. It wasn't the market. It was the markup. In the finance office, Greg didn't tell you the bank approved you at 7.4%. He didn't mention that the dealership is legally allowed to pad the interest rate and keep the difference. He sat behind a monitor angled exactly 15 degrees away from your line of sight. He looked at his screen for 12 seconds. He came back with 10.4%. This is the convenience tax. You paid $3,142 for the privilege of not talking to a woman named Diane at the local credit union 2 weeks earlier. Greg is a professional. He is calm. He is wearing a watch that costs more than your first car. He knows that most people are rate blind. They compare their new loan to their old credit card debt and think they are winning. They aren't winning. They are being harvested. Every month, a portion of your paycheck travels from your bank account, bypasses the principal of the loan, and lands directly in the dealership's profit pool. It is a silent transfer of wealth. It is the price of being unprepared. You see Marcus at work the next day. He just got a truck at 14%. You feel better about your 10.4%. This is the second trap. Comparing your disaster to a larger disaster doesn't make you safe. It just makes you average. You could have sat across from Diane at the credit union first. You could have put a pre-approval letter in your jacket pocket. You could have told Greg you already have 6.1% and watched his automated system suddenly find a way to beat it. The back office, add-on blur. The door to the finance office is heavy. It shuts with a quiet, expensive thud. You have been at the dealership for 5 hours and 17 minutes. You are tired. You are hungry. Your jaw is tight, the way your mother's jaw tightened when the car made a noise in 1998. Greg knows this. Fatigue is his best closer. He starts the menu presentation. Gap insurance, extended powertrain warranty, fabric protection. He doesn't say they cost $4,200. He says they cost an extra $18 a month. It sounds like a rounding error. It sounds like peace of mind. It is actually a 200% markup on products you could have sourced for the price of a dinner out. You sign the paper. You sign the next one. You don't read them. You just want to drive. By the time you get to the parking lot, you have financed a tire protection plan at 8.9% interest for 72 months. You just paid $1,800 for someone to tell you they won't cover the specific type of puncture you'll eventually get. You're now paying interest on top of a markup on top of a service you didn't need. This is the invisible ceiling. You wonder why you can't save money. This is why. The tax of this mistake isn't just the money. It's the recurring realization every month when you see the statement. You remember the heavy door. You remember the expensive pen. You remember that you didn't say no. You could have called your insurance agent on the drive over. You could have added gap coverage for $6 a month instead of $1,100 upfront. You could have looked up a third-party warranty for $340 a year. You could have just said no to the fabric protection and bought a $12 bottle of Scotchgard on the way home. The 72-month depreciation cross. The new car smell is a chemical illusion. It lasts about 6 months. The 72-month loan lasts for 6 years. This is the depreciation cross. You wanted the sport trim because it had the black wheels and the better screen. You put $0 down because Vance said you didn't need skin in the game. Now, you are underwater. The car lost 15% of its value when you drove it over the sidewalk. Your loan balance is $31,400. The car is worth $26,200. You are driving a $5,200 deficit. If you lose your job tomorrow, you can't sell the car. You would have to write a check to the bank just for the privilege of not owning it anymore. You aren't an owner. You are a temporary occupant of the bank's property. By year 4, the car starts to rattle. The tires need $840 worth of rubber. You still have 24 payments left. This is the slow bleed. While Marcus is driving a paid-off car and putting $498 a month into a Fidelity Index fund, you are still sending that same amount to a bank for a car that makes you feel anxious every time the check engine light flickers. The distance between your reality and Marcus's reality is $98,000 at age 35. It didn't happen because he was smarter. It happened because his loan ended before his patience did. You could have followed the 48-month rule. You could have realized that if you can't afford the payment at 4 years, you can't afford the car. You could have put 20% down to ensure you never owed more than the metal was worth, keeping your leverage intact in a world that doesn't care about your lifestyle. The negative equity rollover. Vance calls it trading up. It sounds like progress. It is actually a financial virus. You owe $18,000 on your current car, but Vance will only give you $14,000 for it. You are $4,000 in the hole. Vance tells you not to worry. He will pay off your trade by rolling that $4,000 deficit into your new loan. Now, you're paying 9% interest on a car you no longer own. You're paying interest on a memory. You are $4,000 underwater before you even turn the key of the new car. This is how the debt becomes infinite. You are now locked into a cycle where you will never own a title. You will always be the renter. You are paying for the new car smell with the ghost of your previous bad decisions. At 2 a.m., you look at your spreadsheet. The numbers are red. The total amount financed is $38,400 for a car with an MSRP of $31,000. You realize that you aren't just driving a car. You're driving a rolling pile of debt that compounds faster than your salary. The tax is the silence in the car on the way to work. It is the weight in your chest when you realize you are working 40 hours a week just to service a mistake you made 5 years ago. Systems compound. Both kinds. The dealership built a system to extract. You have to build a system to build. You could have driven the old car for another year. You could have paid down the principal until you had at least $1,000 in equity. You could have realized that the most expensive car you can buy is the one that forces you to pay for the one you just left behind.